What is the difference between a pre-approval and a pre-qualification? The
This
second $1 million question.
this is probably one of the things that I try to preach more than anything. In my world, a pre-qualification is simply a credit pull, and I'm taking what you put on the application data as fact as far as your income, and when I pull the credit, the liabilities. Now, to me, that is just scratching the surface. Yeah, I see the credit and your liabilities, and I trust you to know what your income is, but trust me when I say what you think you make may be more or less than what you actually make. Especially if you're self-employed. You know what your cash flow is, and you think it's $6,000 a month, but when you file your tax returns and I look at it, it's actually $4,000 a month. That can seriously contract your buying power. So my suggestion and my recommendation for everybody out there to seriously looking to buy, do the full pre-approval. Make sure that your lender, me, I get your pay stubs, your W-2s, your bank statements. I look at the credit. If you're self-employed, I get your tax returns for the last 2 years. We do have other flexible guidelines as far as those that are self-employed less than 2 years and things like that. But those are the typical criteria so that I can look at all of the income docs, look at the asset docs, make sure your credit's in line. So reviewing all of those things means that we've actually took the time to confirm all of those factors so that when you go out shopping for a home and you fall in love for that house and you want me to help you finance it, that I've already covered all those bases, and all we need are the critical elements of the loan, the appraisal, the verifications, the title work, and your insurance, and all the process that you do as their realtor as far as inspections and things like that, along with the appraisal that we do, and get you to the closing table in a smooth transaction. We don't want to have hurdles along the way, finding out after you go under contract that you really don't make as much income as what you thought you did, and then all of a sudden you don't qualify and you lose your earnest money, and you potentially risk your earnest money and due diligence at that point, because the due diligence goes in the seller's pocket in the state of North Carolina regardless of whether you close on it or not. So that is what I would recommend. Pre-approval, always pre-approval. If they don't ask you for the documentation, then it's not a pre-approval.